Large claims don't just hit the balance sheet, they send ripples through the entire insurance ecosystem, from reinsurers to carriers to policyholders. Today, we're diving deep into how large claims impact reinsurance and primary insurance pricing, and what that means for both personal and commercial lines across the P&C industry. Let's start with the basics. A large claim is typically any claim that significantly exceeds the average expected loss. Whether it's from a catastrophic event like a hurricane or wildfire, a massive liability lawsuit, or a single high-severity accident. These types of claims are unpredictable, costly, and often push insurers and reinsurers to rethink how they price risk. So how does this actually affect pricing across the insurance value chain? First, let's talk about reinsurance. Reinsurers are the insurers for insurance companies. They absorb portions of risk from primary carriers to help them manage exposure and stay solvent when large or catastrophic losses occur. When a surge of large claims hits, whether from natural disasters, social inflation, or litigation, reinsurers take a major financial hit. When their loss ratios rise, reinsurers have to protect their own capital, and that means higher prices. What we call a hardening market. Reinsurers raise rates, reduce capacity, and tighten terms. That pressure is then passed down to primary insurers. Now, what about the primary insurers? For insurers on the ground, those higher reinsurance costs come alongside their own rising loss costs. If they're paying out more on large claims and also paying more for reinsurance protection, they have only a few levers to pull. Raise rates on policyholders, tighten underwriting guidelines, reduce appetite for certain types of business. This impacts personal lines and commercial lines in different ways. Let's start with personal lines. Think about homeowners insurance. Over the past few years, wildfires in California, hurricanes in Florida, and freezes in Texas have caused billions in losses. These aren't just isolated events. They're happening more frequently, with greater severity. As a result, insurers are exiting high-risk regions or reducing capacity. Rates are increasing dramatically in catastrophe-prone states. Deductibles are going up, and policy terms are getting more restrictive. Auto insurance is feeling similar pressures. Large bodily injury claims are rising due to social inflation, medical costs, and legal verdicts. This means higher pricing even in stable geographies. Now let's look at commercial lines. In commercial property, large industrial losses or high-value real estate damage from natural catastrophes or fires drive pricing up, especially for high-limit coverage. Industries with high business interruption exposure are seeing much tighter capacity. In general liability and umbrella, large verdicts in liability claims, known as nuclear verdicts, have fundamentally reshaped pricing. Trucking, construction, and product liability exposures are now some of the hardest-hit sectors. Even in more specialized lines like environmental or marine insurance, single large losses from oil spills or vessel accidents can force reinsurers and carriers to reprice entire portfolios. So what are the long-term implications of this? Rising costs for policyholders. As both reinsurance and primary insurance become more expensive, those costs get passed down. This is already impacting housing affordability and small business operating costs. Shifting risk to non-admitted and E&S markets. In many cases, admitted carriers pull back, and excess and surplus lines markets step in, often at much higher premiums and with less regulation on pricing. Innovation in risk mitigation. To control large claims, insurers are investing more in risk prevention technologies, from sensors and AI to advanced modeling and mitigation services. This applies to both personal and commercial clients. Greater use of parametric and alternative risk transfer. As large losses grow harder to predict, some insurers and reinsurers are shifting toward parametric structures or catastrophe bonds to manage risk in new ways. Underwriting discipline and strategic realignment. We're seeing more insurers completely exit high-risk lines or territories, realign portfolios, and implement stricter underwriting rules to cap exposure. Real-world example? In Florida, after years of massive hurricane losses and litigation abuse, many carriers reduced exposure or left the market altogether. Citizens Property Insurance, the state-run insurer, grew rapidly as the last resort option. But reinsurance costs skyrocketed, and even Citizens had to pass along those costs to policyholders. In trucking liability, some insurers stopped writing coverage altogether after repeated nuclear verdicts. Others implemented minimum telematics requirements or capped liability limits to contain exposure. Bottom line, large claims aren't just one-off financial hits, they reshape how insurance is priced, how reinsurance is structured, and how entire sectors manage risk. As large losses become more frequent and severe, Whether from climate change, inflation, or litigation, the entire insurance ecosystem must evolve. That evolution affects every stakeholder, from reinsurers and carriers to policyholders, regulators, and investors. If you found this video helpful, make sure to like, subscribe, and follow InsurKnowledge for more insights into how the P&C insurance industry really works. We're here to help you understand insurance and how it shapes your world.